Welcome to the FedEv Breakdown. We'll be analyzing trapped buyers, the backfill, and the critical price levels to watch for tomorrow's market activity. Remember, dull entries miss the mark. Hollow points always expand. This video is for educational purposes only and is not financial advice. Tonight's tape shows one big trade, ultimately coming down to the beta. We saw a huge gap up, followed by a full sell-off. SPY and the Qs are telling different stories. While gold led, semis lagged, the VIX remained at the lows, and yields dove. A new Fed chair takes the stage tomorrow. In this section, we examine the current setup, why we gapped, and why we ultimately rejected. Don't be shocked by the recent sell-off. A backfill is standard after such a large gap. We ran into the top of the prior gap down, allowing trapped buyers to exit before the price rolled over. The index is down 1.5% from the gap up high. SPY and the Qs have diverged. SPY held up better into the close, with resistance at 757 and a trigger at the 5,185 level. Meanwhile, the QQQ shows relative weakness, printing a doji at the level, with semiconductors acting as a drag on performance. Looking at the tape, gold led while semiconductors lagged. Semis are currently the market driver. As the leader rolls over, the index inevitably follows. The VIX is pinned at the lows near 15 3/4. This suggests the market isn't pricing in panic, but rather waiting. This environment can make selling premium attractive, provided you maintain disciplined sizing and respect key levels. Yields are diving heading into tomorrow's meeting, indicating how the market is positioning itself before the news. It's crucial to understand these movements early. Watch how the price reacts to the volatility, as that reaction matters more than the print itself. The new Fed chair presents a wildcard scenario. We might see the dot plot scrapped entirely, potential moves to shrink the Fed's balance sheet, and general uncertainty as this is their first meeting in charge. Now we will break down the exact index levels for your trading plan. It's about following the lines, not the vibes. 744 is the line to hold. It sits at the top of the doji and aligns with both the 12 and 20 two-day moving averages. Defending this level is key to keeping the current structure intact. Should 744 crack, watch the close at 741.75. This is the next specific level on our radar. Pay close attention to how price action develops as it approaches this number. We are watching the control bar high at 746.90. While some might argue we've already tagged it, I anticipate we will push through and head toward a formal gap fill instead. The formal gap fill target for the Qs sits at 721. With many names rolling over, this is a very live target to keep in mind heading into the Fed decision. To summarize why we rejected, we hit the top of the old gap down, giving trapped buyers an exit. They took it, and the supply forced the rollover. It's a technical sequence that should come as no surprise to a prepared trader. Let's shift to our perspective on index levels. The backfill is entirely normal. It's not a financial crisis, nor a reason to panic and chase puts at the lows. It's simply a textbook gap fill, a reset for trapped longs, and a potential opportunity to sell premium if you know how to size your positions. Focus on these two SPX levels. 757 acts as our resistance to clear. After an up-down sequence on the 4-hour, we need to flip this level back overhead before bulls can regain comfort. The trigger is 5,185. We need to see institutional defense at this level before committing real capital. This is a prime environment for premium selling. With a gap-filled level, low VIX, and elevated average true range, you are well compensated for selling downside, provided you have the discipline to size correctly. As the saying goes, if it gets there, I'll own it lower. We must differentiate between retail behavior and institutional activity. Don't get caught up in the daily noise. Focus on reading the underlying behavior to see who is actually driving the market. Consider the two types of 4-hour bars. Retail activity is reactive. It prints panic and chases highs and lows. In contrast, institutional behavior is deliberate, patient, and often waiting for major catalysts like Fed announcements to make their move. Retailers were in and out all day, showing classic cat-on-a-hot-tin roof behavior. Meanwhile, institutions remained calm. Watch the bars closely. The deliberate ones reveal the true path of the market. Friday's final hour is pivotal. This is when institutions show their true hand regarding risk, determining who is bailing and who is willing to carry positions over the weekend. Always watch that 3 o'clock to 4 p.m. window intently. On the hourly RSI, the 70 level is critical. We saw it act as a clear signal for the highs. Don't sell the initial touch, but when the RSI leans and lingers, take note. All you have to do is watch the chart. Looking at the 15-minute time frame, we are already oversold. The sequence here lines up perfectly with our gap fill target. By early afternoon, we get a clearer picture of whether the sellers have exhausted their strength. For 5-minute day trading, the rule is simple. Are you above or below the RSI trendline? Staying below indicates a weak tape where it's better to stand aside. High probability longs almost always require holding above that line. Semiconductors are currently the primary driver of the index. When they move, the rest of the market follows. The SOXX ETF failed at 616. After hitting all-time highs, losing this level signaled a one-way trip downward. This breakdown was the key trigger for the broader index move. We hit our gap fill target, but the expected bounce failed to materialize. As traders, we must accept that the market won't always follow our thesis. Admitting when the tape says no is vital to long-term success. Today, we observed a bearish RSI divergence. Price reached new highs, but momentum did not. This is a classic signal that often precedes a move back down to support levels. Given the repeating divergence patterns, we are targeting the 22-day moving average, specifically between 540 and 560. The pullback of another 5% remains a realistic possibility in this technical setup. Semis are the driver for this market. When you see a large drop on volume, a follow-through day is standard, not the exception. We aren't deep into the 22-day moving average yet, so plan for more movement. A major washout could land Thursday or Friday. We'll let the market come to us. Next, we examine memory and premium, and where the real opportunity currently lies. Memory stocks, particularly DRAM, took a hard hit today. It's funny how people react when a stock returns to levels it saw just yesterday. These names are back in focus because this is where the cleanest premium can be found right now. A move back to 1868 Form U is realistic on a follow-through day. This is the best put-selling tape we've seen since the pandemic. If you know how to sell puts, this environment pays you. The goal is simple: get paid to set a price where you'd happily own the stock. If it never gets there, you keep the premium. If it does, you own a quality name at a discount. Let's look at the mechanics of DRAM puts. By selling the 68 puts for $2 and considering the 66 strikes for over $1, you can generate significant income. The worst-case scenario by Friday is owning the stock at 65, which is a price level 1 and perfectly comfortable holding. Everyone wants to be a swing trader at all-time highs, but nobody likes the swing when it reverses. If you weren't prepared to hold MU through the recent volatility, that's fine. Just be honest about whether you are a swing trader or a day trader. It makes the decision-making process much easier. Next, we need to address the truth about volatility. It's time to debunk the idea that a trading range equates to market fear. Remember that the VIX runs the S&P, while the VXN runs the Nasdaq. The VIX is currently at the lows, which is not a market screaming for a crash. Watch the VXN for tech-specific risks that the VIX alone might hide. With the average true range rising from 10.69 to over 16, you must scale your stops accordingly. Expecting the same range today as you did 6 weeks ago is a delusion. These wider swings represent normal range expansion, not a market collapse. We'll round out this analysis by looking at the broader tape: solar, software, gold, and the recent SpaceX IPO. Solar names are rolling into head and shoulders patterns. It's fascinating to see this play out while oil prices implode. You would expect solar to catch a bid there, but the entire energy sector is currently trading as a single, correlated narrative. Software stocks are so depressed they don't have much further to fall, yet nobody cared to sell them today, which is a tell in itself. As for gold, it remains the most interesting trade on the board, but until it actually breaks out, it remains unactionable. SpaceX finally broke its VWAP today. For the first time since the IPO, the original buyers are underwater. Since options are now live and relatively cheap, the 195 level is critical to defend. If that breaks, we likely revert to the 180 IPO price. Here is the game plan heading into the Fed. Keep your eyes on the QQQ level of 744, the SPX levels of 757 and 5,185, and the SOXX range. Maintain a premium selling posture while respecting these technical triggers to manage your risk. Know your levels and front-run the reaction. Subscribe and hit the notification bell so you get the analysis before the retail crowd is already positioned. Stay disciplined and trade by the rules.